All right, let's now return to the US. Larry Shover, Chief Investment Officer at SFG Alternatives, joining us now from the CME Group there in Chicago. Larry, great to see you as always. I guess we've just been hearing from the Senate Majority Leader Harry Reid. Didn't sound too positive about the fiscal cliff negotiations, saying that really there's been no real detail discussed, and is saying he's not happy with the Republicans and what the progress has been like. What do you think of whether we are going to see those negotiations accelerate at least?
Well, I think one thing, this is a lot of drama, really common for U.S. politics. And I'm not hopeful whatsoever that anything will get done until the very, very last minute. I mean, I think right now it's just a lot of posturing, a lot of back and forth. It just reminds me of a bunch of incorrigible teenagers that it just can't seem to come together. And it is like making our market stagnant right now. So I don't think we're going to see anything concrete or credible until the very end of December.
Looking too, I guess, then at the other issues around, I mean, we've seen the Greek debt deal resolved at least. Is that your take on what's happened there? Is it really over?
I don't think it's over at all. I mean, and maybe I'm just standing in the wrong queue. I mean, I just feel like right now they have a 180% debt to GDP ratio. I don't think anything's going to happen until there's substantial debt forgiveness by either the ECB, EU, or IMF. I mean, this is just, like they say, kicking the can down the road a little bit further down the road. It's not fixed, and it won't be fixed until there's substantial debt forgiveness.
Larry, do you think it's a step in the right direction, though, to ease some of the burden for the Greek government, to give them, lower interest rates, extend the maturity, allow them to buy back some of their debt? They have to do these things before they can implement programs. U.S. is sort of doing that already with the government borrowing at zero rates. So do you think that it's a step in the right direction? They have to do it?
Well, given that we're doing it, it's probably not a step in the right direction. But for the market's sake, yeah, clearly it's a step in the right direction. And I really don't want to be cynical. I just want to be more of a realist when you see that their debt to GDP is 180%. I just don't see how it's possible how they can get their debt down to a sustainable level without some horrendous amount of debt forgiveness. But to your point, and very well taken, yes, this is a step in the right direction.
The other question, Larry, is U.S. economic data is starting to turn positive. It's at least not as negative. Housing slowly starting to pick up. Consumer confidence seems to be doing okay. And money is cheap. So as long as people are confident on jobs, do you think that you're starting to see investment come through and things starting to get better?
Well, I hope so. But where we need to see it get better is in like business capital spending. And that's something that has lagged just dearly over the past couple of years. When we start seeing more of that happening, then we'll start seeing more jobs produced in the U.S. But yeah, you're right. The numbers have bottomed out and they have been inching a little bit higher. It's a great thing to see. And I think that's what's keeping our market as high as it is. I mean, I do think our market is fundamentally underpriced. However, with all the drama that's going around the world, it's being held up quite nicely by some of these numbers that you just mentioned.
Kumar, I just wanted to ask you about this too, because I mean, you were making the point just before the break about, the fact that obviously there's the government's, giving money basically free to consumers, but not really corporates in a sense.
That's right. The question I was asking is, the government is borrowing money at zero interest rates almost, so their funding costs are nothing. The homeowner is almost borrowing money at very low rates. So the only sector that's hasn't participated, yes, a little bit, is the corporate sector and the high yield sector. So why wouldn't the Fed then target that sector as well and say, they're going to start buying corporate bonds and start buying high yield bonds? It's a step closer towards targeting the equity market. I don't think they want to do that, but they could do that and lower the cost of borrowing for the corporates as well. And then the hiring would start, I would assume. Yeah.
Larry, any thoughts on alternative strategies that the Fed could do to what they've already done, the unprecedented actions they've already taken to try and get corporates actually out there spending?
Yeah, I mean, buying corporates and buying high yield debt, anything like that, obviously it's something that's been talked about and something that would be cutting edge. And I think I do agree that it would help spur on business capital spending. The other spectrum is perhaps doing nothing, because at the end of the day, our economy has to heal on its own at some point. And as we've seen, the last measure of quantitative easing has not produced the returns that the Fed has hoped. So at some point, it's not the Fed's responsibility. The Fed just can't do anymore, and maybe just let us heal on our own.
I just wanted to switch to another story we've been talking about this morning, and that's China and the plunge that we saw in the Shanghai Composite to below that psychologically important level of 2,000. What do you sort of think of this? I mean, does it matter really, in terms of global markets, what we see in the Shanghai Composite, given, the liquidity issues there?
Yeah. From a purely American perspective, people seem to be shrugging their shoulders at the whole thing, and that was a very important barrier, that 2,000 level. But I think the American marketplace was pricing that in, realizing that given that GDP has dropped so much in China, this was to be expected. It's a healthy thing to occur, and things aren't all bad. I think the conundrum right now is that, is China going to be an investment stimulus economy, or is it going to be a consumption-driven economy? That's what we're wrestling with right now. But the stock market is an absolute figure. No one seems to care right now.
Larry, given the amount of money that's being printed around the world, the U.S. is printing as much as they can. I think Japan's going to start targeting a higher inflation number, which means they got to weaken the yen and print more yen. Europe's obviously printing more money to help bail out Greece. Do you think you would own gold and own metals and other commodities as a hedge against all this paper currency?
I would, especially with copper, and that's something I continue to be slightly bullish on, and only because, well, one reason is because of printing of cheap money, but secondly, I think everybody is so bearish from the copper and the macro outlook. They keep citing the fact that there's 900,000 tons in bonded warehouses in China. I've heard that story over and over again. I just think with the amount of robustness in the Chinese economy that's going to be released with the consumption-driven economy, the copper will continue to go higher. Gold's a different story. I mean, gold's a lot more tied to India, as you're well aware. And if the rupee continues to get decimated, as it has been most recently, it's going to be really, really hard for gold to continue to rally from where it is right now.
I guess just then turning to, the OECD's been sort of talking about what it sees happening next year, saying that there is the risk of a new major contraction. It can't be ruled out given its worries about the Eurozone. What do you think of that? Is that a possibility next year?
Well, I definitely think it's a possibility, but what I look at is implied volatility of all the major countries' indexes. And right now, if you look at Europe and the emerging markets, implied volatility is trading at a 5-year low. And that's something that's hard to dismiss. I mean, the market is saying that all is okay or something will be figured out. Not that there can't be a macro shock. I mean, that's ridiculous. Of course, there could be. But volatility at a 5-year low is telling us something that perhaps we don't really want to hear right now.
It's interesting because Kumar was sort of making the point a short time ago on the program about the S&P 500 and where he sees it going next year, that it could get back to those levels of 2007. What do you think on the S&P 500? Is it heading back to new highs in the next year?
Yeah, I think it's a complete binary trade right now. If we don't have a recession in the U.S., the S&P 500 will probably be around 1550 this time next year. If we do have a recession because of the fiscal cliff not being able to get figured out, I think 1100 is probably where we're going to land.
Is that a possibility, you think, a recession then in the US still?
Yeah, absolutely. I mean, right now we have a cage match going on between the Republicans and the Democrats. The Democrats want to curb the filibuster. If they don't get this figured out, surely we could see a 2.5% impact on GDP, which would put us into a recession.
Larry, surely the politicians know and the public knows, and we've been talking about the fiscal cliff for a long time now, and the election has been given to the Democrats, that they will come up with a solution. As you mentioned, maybe they're waiting till the last minute to figure out how many bargains they can get, but eventually they all realize if they don't pass it, that there's going to be a problem. So do you think it will come through, but at the last minute?
I do. I clearly think it will come through and at the last minute. And then again, going back to my volatility allegory, it's like the VIX, the implied volatility of the S&P 500, is trading in the third percentile over the last 5 years. It's very, very cheap. So I think the market's pricing in that something about a 1% impact on GDP will be figured out at the very last minute.
Really interesting, Larry. Always great to get your insights. Thank you so much.
Thank you.
Larry.